Okay, well, welcome back. I am currently still in Chapter 7, Section 1 on deciding to purchase, join, or start a business. And I'm on page 180 talking about franchise ownership. So if you could, or if you have access and you're able to open your Google Classroom and the online text to page 180, you can follow along while I read aloud. Franchise ownership. Purchasing a franchise is another route by which you can become an entrepreneur. A franchise is a legal agreement that gives an individual the right to market a company's products or services in a particular area. A franchisee is the person who purchases a franchise agreement. A franchisor is the person or company that offers a franchise for purchase. More than 770,000 people in the United States own franchises, and the number is still growing. Franchising opportunities are available in virtually every field, from motels to pet stores to video outlets. The Franchise Opportunities Handbook, a publication of the U.S. Department of Commerce, lists more than 1,400 franchise opportunities by category. It also provides information about the costs and capital requirements. Additional sources for finding out about franchise opportunities include the following: A Consumer Guide to Buying a Franchise, published by the FTC, or Federal Trade Commission, books on franchising available at your public library, the Wall Street Journal, and magazines such as Forbes, Barron's, Business Startup, Entrepreneur, and Inc. I'm on page 181 talking about the operating costs of a franchise. If you decide to purchase a franchise, you will have to pay an initial franchise fee, startup costs, royalty fees, and advertising fees. The initial franchise fee is the amount the local franchise owner pays in return for the right to run the franchise. The fee can run anywhere from a few thousand to a few $100,000. It is usually non-refundable. Startup costs are the costs associated with beginning a business. They include the cost of renting a facility, equipping the outlet, and purchasing inventory. Royalty fees are weekly or monthly payments made by the local owner to the franchise company. These payments are usually a percentage of your franchise's income. Advertising fees are paid to the franchise company to support television, magazine, and other advertising of the franchise as a whole. Jim Salisbury purchased the Subway restaurant franchise. For the right to use the Subway name and logo, Jim paid a franchise fee of $12,500. In addition, Jim spent $70,000 renting restaurant space, purchasing equipment and supplies, and obtaining legal and accounting services. During its first year, Jim's franchise earned $36,000 in profits. He paid 8%, or $2,880, to Subway in royalty fees. And during Jim's second year of business, his restaurant earned $51,000, and he paid $4,080 in royalty fees. Again, I'm on page 181. Investigate the franchise opportunity, if you would follow along while I read aloud. The Federal Trade Commission, FTC, Franchise and Business Opportunity Rule requires franchise and business opportunities sellers to give you specific information to help you make an informed decision about your purchase. The seller must give you a detailed disclosure document at least 10 business days before you pay any money or legally commit to your purchase, or commit yourself to a purchase. You can use these disclosures to help you or help answer your questions about the franchise or to compare it with other opportunities you are considering. The disclosure document should include the following: names, address, and telephone numbers of at least 10 previous purchasers who live nearest to you, the fully audited financial statements of the seller, background and experience of business key executives, cost of starting and maintaining the business, and the responsibilities you and the seller will have once you have invested in the opportunity. If the seller doesn't give you a disclosure document, you should ask why. Then verify the explanation with an attorney, a business advisor, or the FTC. Turning to page 182, I'm going to talk about evaluating a franchise. Okay? Some of the things you should do when evaluating a franchise include the following. Number 1, study the disclosure document and proposed contract carefully. Make sure all the information listed above is included in the disclosure document. All costs and royalty fees should be provided. Number 2, interview current owners listed in the disclosure document carefully. Ask them if the information in the disclosure document matches their experiences with the company. Be aware of shills, which are people listed in the document that are paid to give favorable reports. Number 3, investigate the franchisor's history and profitability. Determine how long the franchisor has been in business and review its financial performance. Investigate claims about your potential earnings. The company should provide you with the written basis for any claims made about potential earnings. Determine the projected demand for the franchise product or service in the area where you will locate. Does the demand match the potential earnings? Number 5, obtain from sellers in writing the number and percentage of owners who have done as well as they claim you will. Sellers are required by law to provide this information. Number 6, listen carefully to sales presentations. Be cautious of any sales presentation that pressures you to sign up immediately. A seller with a good offer does not use high-pressure sales tactics. Don't fall for a promise of easy money. Remember that success usually requires hard work. Number 7, shop around. Compare franchises with other business opportunities. Different companies offer different benefits. Choose franchises that interest you and request disclosure documents. Find out what services the franchisor offers. For example, with a franchisor, help with marketing, merchandise, and site selection. Number 8, get the seller's promises in writing. All promises should be included in the written contract that you sign. Remember, the contract is a legally binding document. Number 9, determine what will happen if you want to cancel the franchise agreement. Buying a franchise is a major investment, so you should determine the financial risks of canceling the franchise agreement. And number 10, remember that it's okay to ask for advice from professionals. Lawyers, accountants, or business advisors can review the disclosure document and contract and give you their professional opinion about them. The money you spend for this service could save you from making a bad decision about investing in the franchise. Turning to page 83, I'd like to talk to you a little bit about the advantages of owning a franchise. When deciding whether to buy a franchise, you should also consider the advantages and disadvantages of it. There are 4 main advantages. Number 1, an entrepreneur is provided with an established product or service. This allows entrepreneurs to compete with large, well-known companies. Number 2, franchisors offer management, technical, and other assistance. This may include on-site training or classes, aid with starting the new business and handling daily operations, and tips on crisis management. Some franchisors even offer help on everything from site selection and building design to equipment purchase and recipes. Most also maintain toll-free telephone numbers that franchisees can call for advice. Number 3, equipment and supplies can be less expensive. A large franchise may be able to purchase in huge quantities. Some of the savings they enjoy as bulk purchases are passed on to the franchisee. Number 4, a guarantee of consistency attracts customers. A franchise contract mandates a certain level of quality. Customers or consumers know that they can walk into a franchise anywhere in the country and receive the same product or service. The cheeseburger sold at Wendy's in Long Beach, California will be very similar to the cheeseburger sold in Toledo, Ohio. Some of the disadvantages of owning a franchise, I'm on page 183. Although franchising sounds like a great idea, there are some disadvantages that you need to consider. Number one, franchise fees can be costly and cut down on the profits. The initial capital needed to purchase a franchise business is often very high. Also, some of the profits you earn as a franchise owner are returned to the franchisor as royalty fees. Number two, owners of franchisers have less freedom to make decisions than other entrepreneurs. Many business decisions that entrepreneurs generally make themselves have already been made for franchises. Have already been made for franchisees. Franchisees must offer only certain products or services, and they must charge prices set by the franchisor. Many entrepreneurs object to this control because it inhibits the freedom they sought as independent business owners. Number three, franchises are dependent on the performance of other franchisees in the chain. A franchisee can benefit from the success of other franchisees. But if other franchisees run sloppy operations, customers' opinions of the chain will decline. As a result, customers may stop going to a franchise, even if a particular store maintains high quality standards. And finishing up on page 184, the franchisor can terminate the franchise agreement. If the franchisee fails to pay royalty payments or meet other conditions, the investment in the franchise can be lost. Similarly, when the franchise expires, the franchisor can choose not to renew the agreement. In a little bit, we'll work on talking about entering a family business in some of the other parts of the section of the chapter. Okay? Thank you.